Thanks for attending Risk Fuel webinar and on the WBS platform. A lot of exciting things to go through this morning, this afternoon, this evening, depending on where you are. I was flattered with the turnout that Heard had dialed in. I took it as a great compliment, but last night I saw my wife and daughter watching reruns of Lost, so I'm not so sure it's necessarily what I've got to offer. It's just that everybody's gone so far through Netflix backlog that maybe deep neural networks in the capital markets is going to hold your attention. I hope it does. As for questions, I want questions. I think the best way to handle it will be if you type your questions in the chat, and Ed will collect them, and at appropriate times I'll poll Ed basically 4 questions. So you just type them in there, and, get to sort of transitional spots, get to the questions. Great, so let's start things off. I think getting to know a little bit about who's speaking is probably a good way to kick things off. So first, a little bit about me and about Risk Fuel. So I'm Ryan Ferguson. I'm the founder and CEO of Risk Fuel. Before I founded Risk Fuel last year, in a trader and a quant, Scotiabank and at TD much earlier in my career. As a trader, I got to trade all the fun stuff. Traded credit correlation, equity derivatives, XVA. Those are all very different asset classes, but they have a common thread, basically. First of all, they're all complicated, highly dimensional, nonlinear sort of risks that are traded. And secondly, more importantly for this talk, a common thread is that they have a reliance on slow models. I'm allowed to call the model slow because I started my career as a quant writing slow models. In fact, I had the dubious distinction of trader who got to trade using a model that in this particular case, it was the Gaussian copula model that I'd written for the credit correlation trading desk, and then quickly joined that desk as it got up to speed. So I've got a 360 sort of perspective on what it takes to make a good model. I've got the trader's perspective. I've also got the perspective on that. And finally, machine learning. I'm not a newcomer to machine learning. Master's thesis was on how to use machine learning to design transistors. The idea being that transistor design is really a mapping between the physical space of a transistor, the things like the size of it, the doping profiles, and its performance, how fast it switches on it, these kinds of things. The interesting sort of bit was, as I was speaking with a colleague of mine, Andrew Green, 2018, and we were talking about how to approximate some pricing functions. I don't know what had happened over the intervening 20 years, but for some reason, the idea that this problem of mapping a set of market variables, trade variables onto a price was actually very, very similar problem I'd worked on 20 years ago, where I was mapping sizes and doping profiles onto electrons. So with that sort of idea, basically, and see if we could write something where we learn some of these complicated derivatives models. And our paper, Deeply Learning Derivatives, showed that, I think for the first time really, like there have been papers where people had learned Black-Scholes and stuff like that as far back as the early, but in this particular case, we learned something where the models themselves were a slow, complicated model. And the interesting thing that fell out of that was that it was a tremendous speed up. Machine learning approach basically could return prices times faster. With that observation basically decided that it was time for...
Hi, Ryan. Sorry to interrupt.
Yep.
We can barely hear you.
Okay. No worries. I'd rather you tell me now.
Much better.
How's that?
Thank you. Much better.
Is that better? I don't think I need these anymore either.
Yeah, we can definitely hear you better now.
Yeah. Oh, that's too bad. Well, you didn't miss anything. The results from that work I did with Andrew Green were great. Decided that I was going to devote my next part of my career to actually bring those ideas to commercial reality. And that is what Risk Fuel is basically. So very quickly, what we do at Risk Fuel is we take existing models and we use a neural network to learn an approximation to those models. And when we learn those models, we get around that sort of traditional trade-off between, hey, if we want it to be accurate, well, we have to run it for very much longer with a much finer grid or much more simulation paths. Basically, the premise is that by doing upfront training, we can have our cake and eat it too, basically. We can have models that are both fast and accurate. And very importantly, these models take the same inputs and return the same outputs as the targeted client model. Kind of like that picture there of the car up on the hoist, because I often use that as an analogy, basically. The model that Risk Fuel built is going to look on the outside exactly like the model that we trained against. It's just that on the inside, instead of having a Monte Carlo pricer or a finite differences pricer, it's going to have a deep neural network, and it's going to be much, much faster. In terms of use cases, well, I'll show you a particular use case today, and that's going to be for front office real-time risk management. I think that one's very pertinent right now, given all the volatilities in the market. When I retired to found Risk Fuel, the market had been in a pretty good shape. I felt like an old geezer telling people about 2008 and how it's important to have good tools to manage through a crisis. But I think the recent market volatility has really made the case that things like real-time risks are very important. Obviously, there are other use cases wherever heavy compute is used, like for XVA, for example, regulatory purposes like FRTB. In each of those situations, there's a use case that supports fast models. How we do it, I think we've been over that. We use deep neural networks, and we're going to show how we do it in quite some detail in the latter half of this talk. And finally, Risk Fuel has grown from 1 to 12 over the span of a year. We have a great team. Most of the people come from the capital markets background, because I think the domain expertise is actually very hard to learn. It's not, I don't think doing what we do is something where if you just have a background in AI and machine learning, you can pick up all the tricks of the trade, basically. That said, we do have people that know far more than I do about AI and machine learning. Like, I did my master's thesis back in the 90s, so I have some catching up to do. But we've got this great mix, and we've also got some mathematicians and computer scientists. That said, Risk Fuel really is a modern company. With 12 people, we focus on what we're good at, and that we leverage other partners basically for things that they're good at. In particular, I'd like to call out Microsoft and NVIDIA. Microsoft, in particular, we've worked together on a study that has really demonstrated the potential for using deep neural networks to speed up workloads. NVIDIA's provided access to some very powerful machines, lots of engineering help. That's all very technical, but our other partners like the DMZ, which is an incubator, helps risk fuel out with things like HR, raising finance, all these kind of things. FinTech Sandbox gets us access to market data that we need to be able to validate that our models are working properly. And finally, we have relationships where we're working on research projects with professors at the University of Toronto. So even though we're 12, we leverage our connections into the broader community basically to have a footprint that's a lot bigger than 12. That was long-winded. We'll pick up the pace here. The agenda, basically, this is going to be in 3 sort of parts. First part are going to be some slides where they're going to be quite high level. They're going to explain how risk fuel models work, what they can do, how they can help you meet your goals inside of your organization. The second bit is going to be some video clips, basically, showing how we design our data strategies for training, how we do training. We'll have a dashboard, basically, that can show you some of the power that you can expect from very fast models. And then finally, and this is the part actually I'm looking most forward to, is because you'll have to do the work, and that's some questions and answers. So just laying some groundwork here. I already talked about some use cases. Use case that we're going to look at in our demo is real-time risk management. But there are other 2 main use cases that we see that are going to drive the adoption of risk fuels technology. First of all, the regulatory requirements are imposing lots of costs. If you need to start running your middle office models using the same models that you use in the front office, basically your cost of doing that computation is going to go through the roof. Risk Fuel's solution actually allows you to mimic the front office models by actually learning them directly and then having them be so fast that you can actually apply them across your whole portfolio. And then finally, one that I think is of interest to most quants should be that once you have the ability to sort of in post speed up your model, you now have the opportunity to write more realistic models. You no longer have to use a single factor when maybe a 2-factor model is better, for example. How's the volume? Are we doing okay?
Right.
Awesome.
Yeah, it's not terrible. It does occasionally drop out a little bit. I'm not sure if you're able to go into the settings and maybe slide it up a little bit.
Mic, maybe.
Essentially.
What I want to do with this particular slide is I want to get to sort of dispel the notion that there's something overly exotic about deep neural network approaches. With this slide, it's a lead up that's going to show that everything that we've been doing for the past 10 years, basically, to improve our model performance is actually some way incorporated into the deep neural network approach that we're advocating. So first of all, GPUs have become very popular. Obviously, it's an example of matching the task to the hardware, or maybe the hardware to the task. They're great at things like matrix multiplications, stuff that come up all the time in quant finance. The only thing that kind of stands away in adopting GPUs sort of under the traditional way that people are using them is that you need to rewrite your library code, basically. It's a big task to take something that was targeted towards the CPU and rewrite it to run on the GPU. And I think that's one of the reasons why adjoint algorithmic differentiation has become so popular, because that doesn't require you to throw out your existing library. You can start working and building AAD directly into your current library. That said, it's not for the faint-hearted. you're going to need very talented and therefore very expensive quant developers in order to add AAD into your existing libraries. The one that's most analogous to what we're doing at RiskFuel, in fact, I think of RiskFuel as taking the idea of approximations and interpolation to their extreme limits, is to use a grid basically that you pre-calculate every night when time's cheap, so that during the day you can very quickly look up the appropriate values. This works great if you have pricers that don't have a lot of dimensions, but if you have high dimensional models, I mean, that grid grows exponentially in its complexity basically, and therein lies the problem. In order to make things simpler, often those grids are per deal and also sort of per day, so that those dimensions don't have to be part of that grid. And as a result, so even though it's very, very fast, every night you're recalculating that grid. And finally, it's going to be hard to say anything bad about the cloud, especially given how great Microsoft has been with us. I mean, the only sort of, let's start out with the upsides. I mean, the cloud gives sort of ultimate flexibility. I mean, you get to spin things up as you need them. And also the migration path is very simple. When new stuff comes out, you can rely on the cloud to basically provide the new instances. It's not not something where you have to make those decisions. Basically, it just appears. Downside, of course, is that it can be expensive. And RiskFuel actually has a good strategy for helping people who are considering moving to the cloud, basically get to the cloud and manage those costs. So the whole purpose of that was to kind of show overlaps between what we are currently doing in the industry and with what RiskFuel is offering, basically, so that you don't see it as a black box anymore. First of all, training of the neural networks basically can take a model that exists on the CPU and transfer it to the GPU through training. So instead of having to write CUDA code, you're now in a situation where basically you're just feeding the deep neural network framework, basically. So it provides a bridge basically from CPU to GPU. And again, back to the interpolation grid, if you think of the training set that we develop when we're training the neural network, we generate hundreds of millions of data points once. So we're basically building that ultimate interpolation grid. And the advantage there is that you don't have to rebuild it night after night after night. Downside, of course, is you have to do it upfront once, but that's a one-off cost. Once you have a deep neural network set up, computing the first order derivatives through AAD becomes very, very easy. AAD is just a fancy word for backproper, depending on which school you come from, the other way around. I think I'm going to leave that there. I mean, the other ones we touched on before. I mean, you get the difficulty of integration is, I mean, that you had previously. It's not there because you get the same sort of API. And it works very, very nicely when you want to move to the cloud, for example, because it will help you, instead of just lifting and shifting a huge number of on-prem machines into a large number of in-cloud VMs, basically, it'll help you to consolidate to a smaller, more powerful setup where you're using GPU-enabled virtual machines. So I don't actually think it seems that straightforward, but one of the things that I learned is that it wasn't that difficult to get things to work for that paper that Andrew and I wrote, Deeply Learning Derivatives. But the difference between a prototype and a production system, there's a whole lot of things that go into turning one into the other, basically. And on here are some of the questions that we grapple with basically on a regular basis. I mean, how do we spread training data throughout the domain of approximation? How much do we need? How high quality does it have to be? Once we do that, when we're training, are we going to punish outliers? We're not going to punish outliers. I mean, how bad is it to have an outlier? I mean, personally, as a trader, I've been a big advocate for heavily punishing outliers, because generally you're just going to win the trades that you're the outlier on. So the idea to punish outliers is a very natural sort of thing. So when we talk about cost functions, we have these debates all the time about what the appropriate cost function is. And then finally, even what do you feed into your cost function? What measure of accuracy are you using? Are you training for absolute accuracy, for dollars, basically? Are you training for relative accuracy? And the answer is it's actually tricky, because as a trader, you might trade a much larger notional of way out of the money options than you would close to the money or in the money options. So you really have to come up with definitions of accuracy that satisfy your client. This we're going to leave for the question period. It's a little sort of side project that ties together everything that's going on in AI for quant finance, basically, with the three main sort of strands of machine learning, basically. And this will be the last bit before we step in for some questions. Recently, Microsoft published a study that Risk Fuel and Microsoft Azure collaborated on, where we sped up a real-life production model. So this wasn't a toy model. This was an actual model that was and will be used in production. The model was an FX barrier option, priced using finite differences. It has a full volatility surface, full interest rate curves, and other parameters related to strike, the barrier, etc. I think in total, we had around 80 input dimensions. And since this was destined for XVA system, the domain of approximation had to be very, very large, because we couldn't, I mean, XVA is based on future scenarios, and those future scenarios can be very, very nasty. So the training range wasn't narrowly trained around where the market was today. It was very, very broad. And finally, and we'll get into the results in a bit, this is where having friends at Microsoft really come in handy. The compute required to train to generate the training data. I think somebody estimated when we posted it that it might take 6 years if you're using a single core to calculate all the training data. Fortunately, with the cloud at hand, we were able to spin up 500 virtual machines and crank it out in a little less than a day. It gets better. After that, we had access to some of their top-of-the-line GPU instances for the training. In a nutshell, I'm covering that up for you, aren't I? In a nutshell, on the left, we have the distribution of times it takes a single core to price a trade. And there's quite a distribution. Trades with a short maturity don't take too long. They might get done in half a second. The longer dated trades might take 3.5 seconds. Once the risk fuel model is trained, we were able to price things typically in about 2.2 to 2.3 seconds. Now, if people are fact checking, obviously that isn't 20 million times faster. That's about 1,000 times faster. So, but that's just measuring latency. I mean, one of the real things that GPU compute brings to bear is on the throughput side of things, massive parallelization. So the second part of the study there is to crank the portfolio size. So typically when you're doing portfolio analytics, you're not pricing one trade, you're cranking through the entire book of trades. So as we crank through the larger and larger portfolio sizes, basically that parallelism that we could tap from the GPU just came in more and more handy. Eventually, we were cranking out 1 billion valuations per second. And that would be a number to keep in mind, because when we show you the demo, I think the demo that we use that shows some real-time pricing for a portfolio is using about 100,000. So we've got a ton of upside available beyond what we're going to show you in the demo. And critically, obviously, if you can do 1 billion calculations a second and it produces garbage, well, that's just 1 billion pieces of garbage per second. It's not very useful. So this is an XY plot, basically, of the target model versus the risk fuel model. And you can see they're very, very well matched. Great. So why don't we pause here for a moment? I'll pop on the headphones and we can answer some questions based on that first bit of the talk.
Thank you, Ryan. Okay, so we've got a couple of questions coming in. We've got Praveen's asking, does using DNNs do away with continually generating random numbers, or if the training data is based on Monte Carlo, have you guys seen any bias or disturbance in the randomness?
Well, that's an interesting question. I'm going to try to think that one through for a second. When we, and we'll actually get in on the demo, the very next slide is going to be about how we generate our training data, and training data is critical to whether you can learn the function well. So we've developed a number of strategies basically to place the data on the domain of approximation intelligently. For the most part, we've been getting good results with relatively simple techniques. Our expectation is that as the dimensionality gets higher and higher, it's likely that we will have to use techniques that are popular in Monte Carlo, basically to control variant sort of techniques, variance reduction techniques.
Okay, we're getting quite a few questions coming in now. So someone asked a bunch of questions, so I'm going to let you know all of them in case you want to answer them together. So first up, he had, are you generating training data using GPUs? Second was, how would we integrate the API in our XVA? And would that introduce latency querying the pricing function for every simulation at every time step? 3 was, how long does it take you to generate training data for IR exotics? And 4, what about retraining?
Yeah, excellent questions. And in fact, maybe it makes sense to answer them now before we get into the demo, because it will set up the demo well. So, and they all seemed like they were good questions. So what was the first one again?
So the first one was, are you generating training data using GPUs?
That is entirely dependent on the model that we're learning. So if the model is already on GPU, we would use the GPU to generate training data. That's a great situation to be in, because then obviously the cost of generating training data is a lot lower. Basically, you can generate training data faster and more thoroughly cover your domain of approximation, or more cheaply cover it, depending on which route you want to go. Number 2?
Number 2 was, how would we integrate the API into our XVA? And would that introduce latency querying the pricing function for every simulation at every time step?
Yeah, so we talked about plug and play, and I was serious about that. So if you have a system right now, an XVA system that calls models, there's no reason why the setup that you're using for your pricing models can't incorporate basically a risk fuel model in it. So we've delivered pricing as Docker functions with a REST API, but we've also delivered the raw coefficients of the weights and biases, basically. So fundamentally, it's the weights and biases that are the heart of everything, but putting a wrap around it is we've got entire flexibility to make that fit within whatever sort of system the client currently has.
So the next one was, how long does it take you to generate training data for IR exotics?
Yeah, so one of our projects we're working on right now is a Bermudan swaption. And time, this is the great thing about the cloud, time isn't really the concept now. It's how much do you need to be able to do it. So probably for a Bermudan, you might need north of 100 million bits of training data. Multiply that by how long it takes to run your IR exotic. Is that a second? Is that 10 seconds? And then do the math with the cloud compute and stuff like that. What we found is even with this particular project that we're going to, that we talked about, that we did with Microsoft, the cost of that cloud compute was about $1,000 US, and that was an FX barrier option. So it's not certainly out of the question that complicated IR exotics are going to be tackled using this approach. In fact, we're in the middle of trying to tackle the Bermudan right now.
Okay, and then what about retraining?
Yeah, so retraining, there's a trade-off between the size of the domain of approximation and the need for retraining. So if you have a small domain of approximation, you can get by with using less training data. It's going to cost you less upfront. Might be able to get more accuracy, all those kind of things. But you run the risk that you'll get something like happening now, and it will take you close to the edge of your domain of approximation, and you'll need to retrain. So that's a discussion that we have with the client. It's a trade-off between the cost, basically, the accuracy, and the desired sort of longevity, or how big that domain of approximation is.
Okay, so we do have quite a few questions coming in now.
Why don't we plow on with the demo?
Yep.
And with that, there's basically 4 little video clips, and at the end of each one, so I think they're typically about 3 minutes long, and then we'll open up for questions each time. So maybe we will actually address them in those clips.
Okay.
But if not, we'll open it up after every clip, basically. Excuse me while I find the clips here. So I produced 4 clips, and it kind of it steps through the sort of typical process. The first clip is strategies around data generation, and the next bit will be around training. 3 is a bit of a show-off thing, and then 4 just kind of wraps things up. So we will start off with for 1 here. Figure out how to move that over there. Move that there. Presumably you guys don't see that. There you go. This is so much more difficult than, oops, got the wrong one. Okay, sorry about that. Okay, data generation. So the first the first decisions that we have to make, and we do this in conjunction with the person whose model is being sped up, is the size of the domain that they want to cover. So in this particular case, and this is just 5 plots, this is an 80-dimensional pricer. We're not really showing all the 80 dimensions here. But when we start generating data, we generate synthetic data, and we want to spread it out across that domain. We don't really want to have hot spots in one spot or not in the other spot, because one of the things we want to do is to be able to guarantee to our clients the level of performance. So that's why we opt for synthetic data generation over relying on, say, historical data generation. With historical data generation, you're going to be fine as long as what you're interested in has happened before. By using synthetic, we set it up so that we can anticipate things that haven't happened and be ready for them. Just to make sure that everything's nice, though, in the validation stage, we've got access through our partnership with FinTech Sandbox, and we run years and years of existing data, basically, through our models to make sure that we're getting good pricing on stuff that we have seen before. Here, what's happening here is, while I'm chit-chatting, is we have data being generated and sort of filling in this giant 80-dimensional hypercube. We're choosing sort of a random uniform distribution of term and also one for strike, so that should fill in pretty uniformly. Other things like call value, we don't control that. That's an output of the model. You can kind of see that things make sense there. I mean, there's an awful lot of zero-valued models that where the strike is out of the money. And let me get the thing here. So if you look along here, basically these have very, very low value, and basically the at the money point is 1 here. So you have situations where things that are in the money, well, we don't have 0 values there. Those are the ones that contribute to a very high value. So you get this sort of distribution. The thing that is non-trivial here is when you start looking at volatility surfaces with things like term and strike. I mean, they're single independent sort of parameters, so you can just set them up to be uniform distribution. You can't have a uniform distribution of your 1 year 10 delta vol and your 1 year 90 delta vol. I mean, that's just not going to work. Most of that stuff is going to be completely arbitrageable. So we develop techniques basically to make sure that we cover what we're calling the manifold of acceptable volatility surfaces, basically, and making sure that we're not missing out on ones that might actually occur, basically. That's a very important aspect of what we do. I'm going to speed this up because
Ryan, the viewers are having a bit of trouble seeing what the axes are. Would you be able to explain a little bit?
Certainly. So we're learning an 80-dimensional model. What we do when we start generating training data is we have a lot more than these up. This what fits on a laptop screen, but we basically slice and dice those 80 dimensions up into 2x2 graphs. So call value versus term, various volatilities versus each other. So this particular one in the top right basically shows you the term structure of volatility. And you can see that we have some very steep and some very downward sloping vol surfaces. And of course, more normal ones that lie along this axis and stuff like that. You can see the sort of ranges that we actually train on too. I mean, we train up to an 85 vol and a 70 vol. I mean, these are very, very high vols because we don't want a situation where we get this sort of market volatility and you absolutely need your model to work and you're outside the domain of approximation. So typically on our screen, instead of having 5 of these, we'd have 25 or 30 of these, and we'd just be making sure that we were getting coverage. I don't think you can probably read it, but what we've got up in the top left-hand corner basically shows you those 80 input parameters. So we have a term to maturity, we have the relative strike, a domestic interest rate curve, a foreign interest rate curve, and basically a 5x12 volatility surface. I'm just going to speed this along to the end. Not much is going to happen. It's going to fill in better. One thing to point out is at the end here, it says we've got 5,322 data points. In the final basically, for this particular model, we were up at 100 million data points. But when we start off our data generation, we use tools like this to make sure that we've got our distribution set up properly so that we're getting the coverage that we expect. That way we don't generate things for days basically and find out that we've missed sort of holes in the domain of approximation. I'm going to switch back to camera and we can do some more questions now.
Okay, let's see if we've had anything come up. Actually, no, it's just people asking what the X and Y axes were on the graphs. Do you want to go back to some of the previous questions? Or yeah?
Yeah.
Okay, so let's have a look. We had, how is the universal algorithmic differentiation different from AAD or DNN?
How is what, sorry?
So saying that, so the full question was, and it's escaping from me now, is FinCAD says it uses UAD, Universal Algorithmic Differentiation, and how is that different from the AAD or DNN approach?
I'm not familiar with UAD. I mean, AAD and backprop are essentially the same thing. And one of the great things about using the DNN approach is that tools have been built for machine learning, things like PyTorch, TensorFlow, etc. So AAD is typically something very difficult to code into your existing libraries. But if you go from your traditional model, you do machine learning on it, you get AAD essentially for free, because the machine learning packages that you use, like PyTorch and TensorFlow, basically implement that. I think implementing AAD for us took like 2 or 3 lines, as opposed to, I've never done it by hand. I understand it's quite daunting. As for UAD, I'd be happy to speak with the individual asked that question and learn more about it.
So for new questions that have appeared, it seems the training data is simulated?
Yes.
And why is it not deterministically drawn in all 80 dimensions?
It can be. You can place the data where you want it. I mean, so techniques like quasi-Monte Carlo are certainly applicable.
Once you train your models on an instrument, would it require retraining for different clients? It sounds like retraining would be needed only when market conditions change.
Yeah, if we had our own model and then we trained that model to have like the risk fuel acceleration, that'd be fine. We could provide it to multiple clients. But clearly, if we're training something for a particular client using their model, that has their intellectual property in it. So basically what we're doing, back to that picture of the garage, we're tuning their model and they drive out with their model, but it's not something that, it remains their intellectual property.
Okay. When you sample the input space, do you assume some dependency or correlation among input variables?
Yeah, that was back to that data gen sort of slide, basically. We tried to make as little assumptions as possible. We want to make sure that we're not making assumptions that omit valid sort of points in that space. Good examples that have become popular recently around like volatility is like a lot of people didn't think that there could be a W-shaped fall smile, if you want to call it. And now there is. So we don't want to do something where we train things saying that that can't happen and then have it happen and not perform well.
And finally, do you actually see advantage of using 100 million points? What level of accuracy can you achieve with fewer training points? And did you do any studies regarding the effective number of training samples?
Yeah. So in that paper that I wrote with Andrew Green, it was actually quite interesting. We found that it was more important to have a lot of data than good data. So one of the things that we did is we turned down the quality of our data so that we could calculate it faster and get more data. And generally, more data, as long as it didn't have bias in it, would lead to better results.
Okay, that's it from the chat, so carry on.
Perfect. So the next bit, we leverage a tool made by Converge.io. And Converge has basically built something which I sort of liken to an operating system basically for machine learning. So you're seeing the front end GUI here basically, but in behind they provide ways of making sure that you source your tasks out to the appropriate resources. You can see up at the top left, we've got NVIDIA Azure. So this actual process was something that we trained on one of those sort of beast machines that we've got access to a relationship with Microsoft and NVIDIA. Converge has been great. We've been using it for about 2 weeks, actually. Before we used Converge, we were basically building some very similar tools ourselves. A lot of this stuff is so new. Everybody's building the tools. Well, these guys are doing a great job, basically. It makes a lot more sense for us to focus on what we're good at and leverage what they're good at. In this particular graph, this is a very, very standard sort of loss as training progresses. You can see that initially performance improves dramatically. It's not good, but it goes from absolutely terrible to somewhat decent. Basically, as you go further along, what do we got here? Split the, they lie on top of each other, sorry. This is another way that we look at error. So when you look at the graphs, the line graphs, basically, it doesn't tell you about how your error is distributed, what kind of distribution. And if you choose L1 or L2, it's going to affect whether you have outliers or you don't have outliers. So what we like to do is we like to look at these sort of histograms as training progresses. So basically, it starts off very wide, and then you can see it converged to a very, very tight and narrow histogram as training went on. We like to even take that one step further, because even though we know what our distribution of errors looks like, we like to have an idea of where those errors are. Are we doing a good job across the entire domain, or are we doing well in some spots and not in others? So you can see at the beginning here, this is the slider allows us to slide from the beginning towards the end. At the beginning, we got a lot of nastiness, and as training progresses, we sort all that out. At the top, basically the value of those options are 0, so it's very easy to learn those even right from the beginning. As time progresses, it takes on the stuff at the money and stuff like that, and can learn those. I think we'll see that a little bit better in this next example. So in this particular case, you can see that at the money is a little bit difficult to learn. Out of the money, on the other hand, and in the money, we're fine. And that makes sense, because those are sort of asymptotic sort of areas. Particularly here at the money, for very short term, has been hard to learn. And again, this is where the area has the most convexity and stuff like that. So It makes sense. The parts that are the flattest with least convexity get learned very quickly, and then the areas of interest require more effort. Fortunately, we only slid that about 10% of the way, and you can see here that all we needed to do is we needed to let training run a little bit longer before we were able to get good results at the money as well. Just for good measure on the puts as well. We'll take more questions now, Ed, if more have come in.
Seeing one so far, does your loss include a term to measure the error between the true derivatives and the neural network derivatives?
That is a very interesting approach, and we haven't tried that yet because we don't have access to the true derivative cheaply. So if somebody had a setup where they already had AAD, for example, I think that would be a great way to do training. I've seen research on that, but typically our clients don't have AAD implemented. And then the question is if you want to calculate those derivatives by bump and reval, does it make sense to calculate those derivatives or generate more training points throughout the approximation domain? And our view generally is that it makes more sense to do the latter.
Okay, and another one that we've got here is if models are clients and it's the training or approximate method that is yours, then is this your core value add that is a unique or patented way of approximation?
I missed that. Sorry, can you?
If the models belong to the clients and it's the training or the approximation method that is yours, then is this your core value add that is, say, a unique or patented way of approximation?
Yeah, we do have intellectual property around a number of the aspects, how we train, how we generate the data, for example. I think of our value add, and again, we return back to that sort of mechanic. It is the client's car, and we work with the client basically to generate a result that the client's happy with. We're not building our own cars. Basically, we're the AMG division of Mercedes-Benz, or was basically when people used that sort of functionality to basically take stock vehicles and turn them into supercars.
And where is market data integrated into this process?
I mean, like real data.
Yeah.
Two places. One during the validation stage. So we do our training, testing using synthetic data, but we do a lot of validation using historical data to make sure that our model performs for anything that's ever been seen. And then finally, of course, the whole idea is that once these are deployed, they're going to be seeing market data regularly. So basically, those will be inputs to the actual pricer.
So we're also being asked if there's going to be a playback of this, and I can answer that. There is going to be, if you follow Quants Hub on YouTube, then you'll be able to see the recording of it, and we'll send out a link to that to everybody that's signed up. But apart from that, could you talk about your process for creating synthetic data, and could you talk about the computing infrastructure that is needed from the client side, such as on-prem or cloud?
Yeah, we like using the cloud because, again, back to that earlier comment, I mean, if you're generating 100 million data points, I mean, you can do it over a very long period of time on a small sort of setup. But what we like to do, we like to use spot instances. I mean, we're the perfect sort of background job. Like, generating training data is not a high priority thing. It's something where we just want to get it done. So we're always kind of lurking in the background, willing to use the CPUs that nobody wants to use to generate training data when they're cheap.
Lovely.
Carol?
I
was going to say, why don't we move to the next show-offy sort of thing? We got two left, but I'm happy to have as many questions after and stuff like that, but I figure just to have a few at each time. So this really is why I founded Risk Fuel, because when I traded using a static Excel spreadsheet for most of my 15 years. I'd have this is the FX American option that we generated training data for in the first scene that you saw as training in the second scene. Here it's integrated into our vision of a real-time dashboard. In this particular case, just to make interesting things happen, this is synthetically generated data, but I mean, we've got some random processes there. It's just throwing data at the risk fuel pricer. There, in this portfolio, there's 1,000 trades, and we're pricing all 80 Greeks and a value multiple times a second, and that's minimum 80,000 prices per second. And again, if you refer back to what we were able to do on the NVIDIA tenant on Azure, where we were ranking out 8 billion, this is by no means pushing the capabilities of what a risk fuel model can do. People have dashboards like this. I mean, you see them on the trading floor, but the people that have had dashboards like this are the people that trade cash instruments, or maybe even exchange traded options. People who have to calculate the value of their instrument and have to calculate the derivatives using things like Monte Carlo and finite differences don't have this functionality. This is truly the sort of game-changing sort of functionality. Can you imagine sitting there when oil goes to -40, or the craziness with rates and credit that's happened over the past month or so, and being able to actually see your position update in real time? I mean, when I was trading, I knew my position was changing, but I'd have to wait overnight for the overnight batch to complete in order to, to find out how much money I made, and also how my risk changed. I'd get my roadmap first thing in the morning, and that was the one map I had, even if the conditions were changing throughout the day. This the thing I like the most about this dashboard isn't the real-time P&L, actually, and it's not even the real-time Greeks. It's that middle set of bar charts, the P&L attribution, the idea that you can actually know how, not just how you're doing during the day, but why you're doing that well. The number of times that I was asked as a trader, "Hey Ryan, how you doing?" And I'd say, "Yeah, I think I'm up 200 to 400,000. I mean, that was a typical daily sort of conversation. Here, you'd be able to say, "I'm up 317,000, and the bulk of it is from my GBP USD Delta position. I did lose a bit of money on dollar Swiss Vega." I mean, the ability to be able to do that, and the credibility that that's going to give you, and the ability to manage your book, I mean, that's truly game changing. So, next round of questions.
I'm not yet seeing any new questions. Oh wait, here we go. No, we don't. So, let's see. How do you train for sensitivities? Do you do it on actual sensitivities?
That's a good question, and that's actually going to come up in the final bit when we get on to accuracy. We don't train on actual sensitivities. That was related to that earlier question. If sensitivities were cheaply available, that strategy would make sense. One area that we've learned quite a bit about in the last few months, basically, is finding good activation functions that can give you sensitivities. Most of our earlier work was using ReLU as an activation function. ReLU has a discontinuity, and it makes it not great for calculating derivatives. We found with some continuous activation functions, we can actually get very good quality first order Greeks.
Okay. Right, so new question. How frequently do you need to train?
Ideally once. If you set the domain of a, okay, well, I guess there's two ways to answer that question. Ideally, if you pick the domain of approximation correctly and the underlying model is static, you shouldn't need to have to retrain. But obviously, if the underlying model doesn't account for negative crude rates and then they change their model, well, then the new model will have to be learned. So that's I wouldn't call it a shortcoming, but if the underlying model changes, well, it's a new model and has to be retrained. If that isn't changing and the domain that you trained on is sufficiently large that you're not moving out of that domain, you may never have to retrain. And then finally, around training, one thing I didn't show in that training slide was it looked like we were training one neural network. We don't generally train one neural network. I mean, we train dozens and dozens with different sort of parameters and try to figure out what sort of hyperparameters basically will give us a good result. So we don't retrain, but during the process of training, we probably train many dozens basically.
Okay. And how would you handle interest rate products whose value depends on calendar information like accrual fractions? And would these be inputs to the network?
Yeah, typically things like Asian options or things where something has some path dependence, that state is something that becomes a state parameter for that pricer. Essentially anything that is an input to the traditional pricer, you can think of that as being a state parameter for the neural.
Okay, and do you need to train the neural network for each organization and model?
I'm a bit confused. Certainly if we're training, say, Bank A's Bermudan model, and Bank B comes along and says, well, you train our Bermudan model. Yeah, we will take their Bermudan model and we will train it. Like there's no sort of cross between the two. And that's actually advantageous. When you think about it, one of the issues that people have with neural networks is about how are we going to get these approved? We're learning your existing model. It's already been approved. It's in production. So the way you get a neural network model approved is basically to show that on the domain that it's trained for, that you have acceptably good match between the pricer that's already approved and your approximation. And so back to different organizations, two organizations might have a Bermudan model, but they might have differences, and basically Bank A had theirs approved by the model validation people at Bank A. Bank B had theirs approved by their model validation people. So the easiest way to deal with that is just to have you train Bank A's, train Bank B's basically.
So we've got a few more questions. So do you want to carry on and get some later, or?
Well, I'm going to play this. This is just what we did is we actually then ran the traditional model after we did that scene where we were calculating the P&L in real time, basically. So this is the traditional model. We're not calculating any of the Greeks. And basically, you'll get an opportunity to see what the sort of histogram of errors are and whether risk fuel reproduces the traditional model well. So why don't you ask questions? We'll just have this play in the background. And if it raises any questions that people have, I'll answer those as well.
Okay then. So how does one dynamically validate this approach? For example, if market conditions change significantly, can the user get a sense of how the accuracy would be impacted?
Yeah, and that's the great thing about it, because we train up front, basically. Remember those heat maps. So you will have a sense at delivery how well it's going to work in the various parts of the domain. And generally what we do is that we train to have a fairly consistent accuracy across that entire domain. Sometimes that means adding more data points, et cetera, to certain regions just to get them to train to the same level of accuracy. But yeah, it's not something where you're going to wake up one day still inside that domain of approximation and be worried that, oh, it might not work. Basically, all of that will have been tested thoroughly and validated.
And can you talk a bit about synthetically creating training data? Have you tried using GANs to generate training data, probably in distribution similar to a target?
We've looked at that idea, and we think it's a great idea.
Okay. And how do you handle discontinuity in price, say, across a coupon date?
That's not particularly, be interested in hearing the follow-up to my answer. But things like coupons are schedules are inputs to the model, basically. So presumably the traditional model has valuation that is dependent on those coupons. So when those become state parameters, whether or not that coupon is about to be paid or has just been paid will affect the price, and we'll capture that.
And why not use your approach to actually validate the initial model as part of MRM? So sensitivity analysis, benchmarking.
Do that one more time. That one confused me.
Yeah, it's confused me a bit as well. So why not using your approach to actually validate the initial model as part of MRM, so sensitivity analysis or benchmarking?
Yeah, so I think it's a horse cart sort of thing where we always see that traditional model as being the horse that pulls this along. So we don't create this out of nothing. I mean, to some people, they go, oh, well, this is just fancy interpolation. That is what we're doing. We are building a big, sophisticated space full of 100 million points that we learn how to map that relationship of those points throughout that space. We really do need something that is actually going to tell us what those values are at those points in space. So we can't come before the traditional model. This is something where you have the traditional model, and we can come up with a way to actually infer values much, much more quickly. One thing that it does allows people now to build slower traditional models that are richer, basically, knowing that afterwards there is a way to get them to production levels of performance, basically. You can now work on those ones that would be too slow to run in runtime in a traditional framework. Now you build that model, you generate a massive training set, takes even longer because it's even slower, but you do that once, and then you use risk fuel technology basically to give it the speed that it needs.
Okay, and how do the typical DNN patterns look? Do the optimal ones vary a lot in dimensionality from model to model or data to data?
Yeah, there's a relationship between the complexity of the model and the capacity of the network required to learn it. Obviously, for simpler low-dimensional models, you don't need as many nodes in your network. Essentially, the weights and biases are the free parameters that are being tuned to approximate the function that you're interested in. So if you have a high-dimensional, very interesting function, you then need a larger, deeper network and commensurately more training data, basically, to satisfactorily learn that function.
Okay, and how do you accommodate the need to perform model calibration into your training data?
Oh, great question. I'd forgotten that. So we generally, when we train, we don't train the model. We typically consume the model and the calibrator. So again, when we were talking about an 80-dimensional model, we didn't talk about 5 parameters for Heston or something like that, that might be calibrated down to. What we do is we take the full 60 points on the vol surface, feed that into whatever calibrator the client uses for their model, and then feed that calibration result into the pricer. And we actually just learn the whole thing. So there's no concept of sort of an independent state of sort of calibrated parameters floating around. You've got market inputs and you've got outputs.
Okay, and I've got one last question here is, given the efficiency that comes with your approximation, is it possible to give this to a non-technical user for them to run simulations or sensitivity analysis with a simple GUI?
We're working on that. So the follow-up with our work with Microsoft basically is to take a open source model, likely a Bermudan swaption, and provide basically a risk fuel version of that model, and then allow that user to hack away at their heart's content basically and compare the performance and the accuracy across the entire domain of approximation.
Okay, that's it, unless scavenging for older questions. So, carry on.
So what we, while we were talking there, what happened is the traditional pricer was pricing away the end of day, and it's finally completed. It was great that we had plenty of questions because I think it took about 5 minutes. And you can see that we didn't get exactly the same price, but we thought the P&L was 595,000. And the traditional model thought it was 561,000. Traditional model is also a numerical model, so some of it might be on our side, some of it might be on their side. But I think this is a very powerful result, actually, because what we're trying to do here is a lot more complicated than valuing one instrument. We're valuing small changes in instruments. We actually have to have the risk sensitivities broadly correct in order to be able to get this kind of tie out. Any questions? This was the last bit before the questions part.
I'm not seeing any new ones come in, but obviously if people want to submit some, then I'll be happy to relay them. Oh, here we go. DNNs might have problems extrapolating outside the distribution they were trained on. How do you accommodate for this? And is it through the data simulation explained earlier?
Yeah, so there's a lot of interesting work going on that. Like Antonov et al. Basically had a paper on using asymptotics. It's an area that we're definitely interested in because that would allow us to basically expand the domain of approximation. Right now, the way we deal with it is basically fairly forcefully. All bets are off outside the domain of approximation. It's important to monitor where you are inside that domain, and if you're starting to get close to an edge, then it's due for a retraining. But it would be really nice to use asymptotic approaches basically so that you could take certain ends of domains out to infinity. I mean, that's going to be a very helpful development.
Okay. And how do you handle variations of the same instruments? Do you train one big general model for it or separate models for each variation?
We try as much as possible to do the former. We find that the ability of transfer learning basically between similar models is very high. So the need to go through a full retraining just isn't something that makes a lot of sense.
And accuracy looks good visually. Can you quantify what accuracy you can usually achieve, for example, relative to notional?
Yeah, again, that is completely dependent on how much training data you're willing to generate, how big your domain is, so how tightly you pack that data together, and how good that data is. But we can typically get better accuracy than what I would call the production sort of values for a traditional pricer. So a traditional pricer, Monte Carlo, I mean, you can turn that up to 100 million paths if you want and get very, very high accuracy, but it's going to take you minutes. Nobody does that. But if you're going to use it for training one time, you can actually take that time to make very, very high quality. So the end result is that if you want really high accuracy and you're willing to pay for the compute time to make very high quality data and a lot of it, you can get extremely good accuracy.
Okay. And in high dimensional spaces, most data points will be close to the edge in some directions. Isn't that a problem?
I'll have to set you up with our topologist for that one. It hasn't been a problem.
Okay. And can you speak at all about the architecture of your networks? Are they generally off-the-shelf architectures or highly customized to incorporate some structures of the function you are approximating?
We try to keep it as simple as possible. I mean, obviously some of the stuff is proprietary, but certainly the very first model that we built for the deeply learning derivatives paper was about as simple and classical as you can get. It was a feed-forward neural network. It was almost straight out of that thesis I wrote 20 years ago. That's the difference between prototype and production, though. There's getting something to kind of work and then getting it to really work. So we've spent a lot of time optimizing in the last 18 months.
Okay, so I think that's it for the questions. So unless there's anything that I've missed that somebody wants to post again, there we are.
Perfect. My pleasure.
Lovely, thank you.
I can go back and watch the last season of Lost. It was terrible. Thanks, everybody. Have a good day.
Thank you.
Bye-bye.